I'm Caroline Woods, and this is your NYSE brief on the federal funds rate. A reminder, briefs are for educational purposes only. The New York Stock Exchange does not recommend any investments or investment strategies. The federal funds rate is the target interest rate that banks charge each other for overnight loans in order to meet reserve requirements. The reserve requirement is usually about 10% of all deposits made at the bank. So, for example, if you deposit $1,000 into your account, the bank keeps $100 in the reserves and then can loan out the other $900 to other customers or companies at higher rates, making money off of your money. Banks frequently borrow from other banks to meet short-term funding needs. The interest they are charged to borrow that money is the federal funds rate. The Federal Open Market Committee, or FOMC, meets 8 times a year to determine the target Fed funds rate. This is the Fed's primary monetary policy tool to promote its dual mandates of maximum employment and price stability. The Fed tends to lower rates when the economy is slowing or at risk of entering a recession. It tends to raise rates when the economy is strong and they're worried about inflation. This makes borrowing costs more expensive, usually reducing demand and eventually cooling inflation. So, for example, the Fed cut interest rates to zero in the March of 2020 when the pandemic hit and the economy came to a near screeching halt. By making money cheaper, people and companies were incentivized to spend more, which was intended to stimulate the economy. By making money cheaper, people and companies were incentivized to spend more, which was intended to stimulate the economy. Many have argued, though, that the strong demand, along with logistics and supply chain issues, has caused inflation to spike to 40-year highs. So in March of 2022, the Fed started raising rates to combat that inflation. While interest rates have a longer-term impact on the economy, they often have a more immediate effect on the stock market. When the Fed begins tightening monetary policy by hiking rates, the stock market can go down in the short term as economic growth can be expected to slow. However, there are always exceptions and other factors that may influence the stock market as well. Remember, higher interest rates make the cost to borrow money more expensive. Sometimes a rate decrease can have the opposite effect on the stock market, as borrowing costs move lower, in turn stimulating demand. Of course, there are always exceptions and other factors that may influence the stock market as well. One last thing to note, the Fed doesn't set interest rates for things like mortgages, credit cards, auto loans, or student loans. But remember, when the Fed raises the target Fed funds rate, it becomes more expensive for banks to borrow money from each other. So what do? They often pass those higher prices on to you. So if you hear of the Fed hiking rates, you'll likely feel the impact. And if they cut rates, borrowing might become a little bit cheaper.